Let me tell you everyone, now is a fantastic time to buy a home. Mortgage rates are at record lows, and that means that you as a potential home buyer or real estate investor should buy today and lock in these low rates for the next 30 years. Buy today and don't think about the fact that we're in a big housing bubble. Don't think about the fact that home prices are at all-time highs relative to inflation during a recession. These things are not important. What is important is solely the low mortgage rate and monthly payment, and that means that we're not going to have a housing crash. The housing market will continue growing, and thus you should buy now. And I'm sure that you guys have seen this very incorrect argument perpetrated before by people who are bullish on the housing market. They think that low interest rates somehow mean that home prices can't come down. And in this video, I'm going to explain why they are dead wrong. I'm going to give 50 years of data on U.S. mortgage rates and home prices and explain why low rates actually are more of an indication of a future housing market crash than they are continued price appreciation. And this is something that you really need to understand if you're a home buyer or a real estate investor right now. I know a lot of you are feeling the pressure, you're feeling the FOMO. People are saying to you, low rates buy now. I'm saying don't listen to them, and I'm going to give you the data on why that's the case. Let's get into it. And so on this graph, we're looking at 50 years of history of the U.S. housing market, both mortgage rates, the yellow line, and the typical home price in America, the blue line. And what's very evident is that in the last 4 to 5 decades, we've been in a trend of declining mortgage rates. You can see that back in early 1981, in the early 80s, that the typical mortgage rate was 18%, which is wild. If you went to buy a home in 1981, you'd be quoted an 18% interest rate. However, that has consistently declined over the last 4 decades, all the way to a low of 2.9% in July 2021. At the same time, we've seen home prices increase from $28,000 in 1972 for the typical home. They've increased by more than 10x, all the way up to $300,000 in July 2021. So we definitely have this trend over the last 4 or 5 decades of declining interest rates, increasing home prices, and this trend has caused a dramatic change in the cost of buying and owning a home. So we can see on this graph, the blue line is the typical down payment at 10% to purchase a home, while the yellow line is the typical annual mortgage payment. And so what we're seeing is that back in the early to mid 80s, the annual mortgage payment was higher than the down payment, and then the annual mortgage payment and the down payment kind of came close to each other. But in today's era, the down payment is way higher. We're up to $30,000 now for the typical down payment, assuming 10% for a U.S. home purchase, whereas the annual mortgage payment is $16,000. And you can see that this annual mortgage payment has stayed fairly stable at around $16,000. It was $18,000 in 06-07 during the last bubble, and it was actually around $12,000 in the 80s and 90s. So kind of amazing to think that today your monthly payment on your mortgage is roughly the same as it was 40 years ago, but your upfront payment on the down payment is way, way higher. And this is the thing that we really need to think about in terms of the U.S. housing market over the last couple decades, is that the costs of home ownership are now being pushed more to the front end, on the upfront purchase, on the down payment. That's where really a lot of the costs are, and the monthly mortgage payment has stayed stable as a result of those declining mortgage rates. And what a lot of the people who are bullish on the housing market today say is that these stable monthly mortgage payments, which actually as a percentage of income are even lower than they used to be, this means that owning a home is affordable. And as a result, we're going to continue to see a stream of people coming into the U.S. housing market, renters turning into first-time home buyers, because after all, why wouldn't you, with such reasonable annual mortgage payments, monthly mortgage payments for owning a home? It's cheap. But where this argument really fundamentally breaks down is in its assumption that it's the monthly payment that matters, that it's the monthly payment which is the gatekeeper that determines whether someone can afford to buy a home or not afford to buy a home. That couldn't be further from the truth. In fact, it's the exact opposite. It is the down payment today, which is really the hurdle. And it's the hurdle that's causing a lot of renters and first-time home buyers to be completely priced out of the housing market. And to get a sense of what I'm talking about, let's look at some data that comes from the Federal Reserve. And on this graph, we're looking at the amount of money that Americans have saved in their checking and savings accounts over the last 30 years. This comes from the Federal Reserve Survey of Consumer Finances. It's a triannual survey, comes out every 3 years. The most recent data is from 2019. It goes back all the way to 19 1989. And the blue line is showing the amount of money in bank accounts of homeowners. And we can see that homeowners have done a lot better over the last couple of decades in how much cash they have. They've gone from about $28,000 to $31,000 on average in the average homeowner bank account, all the way up to close to $60,000 in 2019. So homeowners doing a lot better in terms of how much cash they have on hand. However, renters, the yellow line, not so much. Renters are actually worse off today than they were 30 years ago in the amount of cash that the average renter had in their bank account. Back in 1989, the average renter had $14,700 in their bank account. In 2019, that was $13,000. So in nominal terms, renters in America today have less money saved up than they did 30 years ago. And that's nominal terms. If you were to adjust for inflation or compare to what home prices are, they have way less money saved up than they used to. If you guys are a potential home buyer and real estate investor who's thinking about whether now is the right time to buy, where you should buy, then just make sure to like this video. When you do that, it gets me a bit more exposure on YouTube and actually allows me to put out more of this content for you going forward. So make sure to like the video. Also make sure to leave a comment. I want to hear what your experiences are in the housing market as a buyer, seller, renter, investor. What are you seeing? When you guys comment, it makes these videos better. All right, let's get back to it. This looks even worse when we consider not just the average amount that renters have saved, which is again the yellow line here, but the median amount, which is the green line. The median amount, this is the amount that the middle renter has. So if we had 100 renters, the 50th renter right in the middle, they would have savings of $1,600 in 2019. $1,600 in their checkings and savings account, and you can see that this is lower than the $2,000 that the median renter had in 1989. And this is a sign that renters have been left behind economically in America over the last 30 years. By and large, they're living paycheck to paycheck. They have a lot of debt. They're not able to save money, and this means that their financial situation today is worse off than it was 30 years ago. And this is a big, big problem for the U.S. housing market because it's these renters who should convert to become first-time home buyers and support the housing market going forward. But yet we can see from that data that these renters and potential future first-time buyers are really struggling financially. They're living paycheck to paycheck, they're not increasing their savings, and they're not even coming close to being able to afford the down payments that are required in today's housing market. And you can see that represented on this graph where we're looking at, in yellow once again, the average amount that a renter has in their bank accounts over the last 30 years, and then the blue line, which is the typical down payment at 10% required for a home. And what we can see is that in the late 80s, early 90s, this yellow line was above the blue line. Savings was higher than the down payment. And that's the sign of a healthy housing market. When savings is above the down payment, that means that there's a high number of people that at any given time can afford to buy a home, and that means stable home prices. Of course, something changed in the late 90s. As I've talked about on this channel multiple times before, the housing market in the US fundamentally changed forever in the late 90s. First time ever where home prices really started going up above levels dictated by the fundamentals. And we can see by 2007, the peak of the last bubble, the down payment required was $22,000, yet the typical renter, the average renter, only had $12,000 in their bank account. Obviously not a sustainable situation, because who's going to be able to step in and support demand for homes when the down payments get that high? And of course, home prices crashed, down payments went down. And unfortunately now in 2021, we are in a very similar situation we were in 2007, where the down payment required is just way above what the average renter has in their bank account. And this is a reality that people who are bullish on the housing market, they are trying their hardest to ignore this reality. You know, a lot of people who are bullish on the housing market, they have a financial interest in seeing continued home price appreciation, whether they work for a company like Zillow or whether they're a realtor or a local investor. They all have financial interest in seeing continued appreciation. So a lot of them don't allow themselves to understand the actual realities that renters in America are facing. Renters, the people who need to become home buyers in the future to support the market, they are not even close to being able to afford today's housing market. We don't even need to look at the data for this. Like, it's obvious, right? If you were to ask any renter in most markets, oh, how do you feel about buying a home right now? The answer is no, I don't feel good. I feel priced out of the market. I feel like I'm going to wait until prices decline. And we can actually see this in housing surveys. Every month, Fannie Mae comes out with a monthly housing survey where they ask Americans, what are your thoughts on the housing market? Is it a good time to buy? Is it a bad time to buy? And this survey is showing that an overwhelming number of Americans think that it is a bad time to buy a home right now. You can see that outlined on this graph where the blue line is showing the percentage of Americans that think it's a good time to buy. The red line showing the percentage of Americans that think it's a bad time to buy, and the green bars are showing the difference between the two. And you can see that historically, over the last 10, 11 years, Americans are traditionally very bullish on the housing market. Americans generally think it's a good time to buy a home. They generally think that up until about a couple months ago, when all of a sudden now a majority of Americans think it's a bad time to buy. Through August, 63% say it's a bad time compared to 32% that say it's a good time. So you can see for the first time in history now of this survey, these bars are in the negative. More people think it's a bad time to buy than a good time to buy. So that's super interesting, right? A record percentage of people think it's a bad time to buy a home. We've never had so many people so negative on the U.S. housing market. Yet mortgage rates are at record lows. I wonder if that could be an indication as well that mortgage rates are not what drives the bus, are not what matters in the U.S. housing market. And when you combine this data from the Fannie Mae Housing Survey with the realities of how much money that renters have saved up, the data from the Federal Reserve Consumer Finance Survey, it becomes very obvious that it's the price in the down payment which dictates the fundamental feeling and demand for homes in America. It is not the mortgage rate. It is not the monthly payment. Now, I think some of you might be saying, all right, Nick, I get that, but I'm scratching my head about something, right? Because I'm saying to myself, all right, but if like the traditional renter and first-time buyer isn't stepping into this market right now, like who is? Who's causing home prices to go up so much in America, especially over the last 3 or 4 months? And the answer is pretty simple. It's investors. And investors are the ones who are using low mortgage rates as kind of an excuse to enter the housing market at record high prices. And we've seen a big, massive surge in the amount of investors, both big and small, buying homes over the last 6 months or so. And you can see that represented on this graph, which comes from Redfin. They're tracking the number of homes purchased by investors in America each quarter. And you can see through the second quarter of 2021, we're at an all-time high. 68,000 homes purchased by investors in America. It's never even been close before. And what you can see is this run-up in investor home purchases is very similar to the run-up that occurred in the early to mid-2000s, 02, 03, 04, 05. We had a big spike in investor home purchases in the last housing bubble. And that was one of the things that really caused the last housing bubble to really get speculative. As a lot of investors piled in, pushed prices up further when a lot of regular Americans all of a sudden were priced out. Of course, when the housing bubble burst, the amount of investors buying homes collapsed. You can see that this investor home buying comes in all shapes and sizes. And this is a graph that comes from the CoreLogic Investor Home Buying Report, and it shows the percentage of investor purchases that come from small investors in green, mid-sized investors in orange, and then large investors in blue. And we can see that small investors, those who own fewer than 10 homes, mom and pop investors like many of you watching this channel, they are a majority of the investor home purchases in America. Over 50% of those investor purchases come from small-time mom and pop investors, and that's primarily who's driving investor demand. At the other end of the spectrum, you can see that large investors, those who own more than 100 homes, only represent about 10 to 15% of all investor purchases. So it's these investor purchases, primarily coming from small-time mom and pop investors, which are stimulating the housing market right now. The typical renter first-time buyer is priced out. In steps the investor. Maybe they have $100,000, $200,000, $300,000 in the bank. They want to become a landlord. They snatch up a couple homes. That's what we're seeing predominantly in America's housing market over the last 3 to 6 months. And the problem is this investor demand is not going to end well. Investors do not represent fundamental demand for homes. They are speculative and transient demand. As soon as home prices start to come down, which is exactly what happened in 06, 07, as soon as prices start to come down, many of these investors who were stimulating demand and buying homes are all of a sudden going to start to sell homes because they can sell homes very easily. It's an investment. Meanwhile, if it were a first-time buyer, someone who lives in the home, they're not going to sell their home because they need to live there. But an investor, very easy for them to all of a sudden put the home on the market and basically make the housing downturn turn into a housing crash. And that's why low mortgage rates actually can crash the housing market, because they increase the amount of speculation and volatility, increase the amount of people who are buying and selling who aren't fundamental end users. And yeah, let me tell you, this is not going to end very well for a lot of people who are piling in at the last minute. And I'm going to finish things off with a quote. And this quote comes from the preeminent academic paper on U.S. housing bubbles done by Carl Case and Robert Shiller in 2004. And back then in 2004, they wrote a paper and they asked the question, is the U.S. housing market in a bubble? They asked that question. They used data to try to understand if it was. And what they found in that paper is that many people were suggesting the U.S. housing market was not in a bubble in 2004 due to low interest rates, low mortgage rates. Let me show you what I'm talking about. All right, guys, so this is the paper, Is There a Bubble in the U.S. Housing Market? Carl Case, Robert Shiller, 2004. This is probably the best thing you could possibly read if you want to learn more about how the U.S. housing market works. I recommend you all read it. I'll have a link in the description. But if we scroll to the bottom of this paper, kind of towards the end, page 43 on the PDF, we see here the last paragraph on this page. It's a very interesting one. I'm going to read it slowly for all of you. Clearly, one can construct an argument that home price increases nationally since 1995 through 2004 have been driven by fundamentals. For more than 40 states, income growth alone explains virtually the entire increase in house prices. And here's the key one, falling interest rates have reduced financing costs sufficiently to keep the ratio of annual mortgage payments to income from rising. In the vast majority of states, housing is actually more affordable than it was in 1995. Does that argument sound familiar to any of you? Of course it does. These same people obsessing over low interest rates and trying to say that low interest rates and mortgage rates mean home prices can't go down, they existed 20 years ago during the last housing bubble, and they were using the same exact arguments, and they were dead wrong back then, and they're going to be dead wrong again. And so, as always, everyone, it's so useful to have historical context and data so you can make a better decision about when you should buy a home, where you should buy a home. And I try to bring you as much data on this channel as I can, 3 videos per week. If you want to see more of it going forward, first make sure you're a subscriber. Amazingly, only 25% of my views come from subscribers. I want to get that number up. Additionally, think about joining the channel as a sponsor member. You get a lot of cool perks. There's an exclusive members-only community board here on YouTube where I post data, graphs, and polls that I don't post anywhere else. You can actually have input if you're a channel member into what videos I do in the future. Additionally, there's a monthly newsletter exclusive to channel members. It comes out once a month with an associated exclusive video here on YouTube. The cost is $5 a month. All my current members really love it, so think about becoming a channel member. All right, everyone, until next time, this is Nick from Reventure Consulting signing off.